I think that if you want to solve an issue, you got to figure out in the first place identify the problem. So I don't have any excuse in terms of saying that if there was some failure in our risk management structures or our models. We saw in August last year that there was this unsustainably high growth that was taking place in the industry. We indicated that we were worried about it, and we did cut back throughout the course of from August of that year through to the beginning of this year. But the reality is, with the benefit of hindsight, we were not bold enough in terms of the decisions that needed to be made, and hence this year has been all about trying to get ahead of the curve, because we've been behind the curve, quite frankly.
Just talk a bit more about those processes, because in November last year you said the risk remains well controlled, we are closely monitoring our customer base and the impact and the market as a whole. So you sounded like you were really getting an eye on things there. And then I suppose the big shift happened between November 2012, and by the way, along the way your dividend was constant, your earnings were good, so it wasn't like the numbers were showing problems, but you preempted. Then in May there was an announcement, and that's where the big change is.
Yeah.
What happened to your processes between November and May that you suddenly found all the stuff?
You know, what actually happens is that we normally have difficult collections in December and January, because obviously customers are go on holiday, they've got less money to spend, etc. Then February sort of is a halfway mark, so you start to get a recovery in February, but in reality you only know by about March what a normal month of collections looks like. And really it was at the end of March that we saw what we saw, and really came to the realization that we were looking at something that was pretty different to what we had been expecting up to that point. And you know, the one thing, David, you can't do anything about the past, but you can do everything about the future. So if you're going to do something and then get it, and then prepare yourself for the future.
4 billion rand was the rights issue, and then it was 5.5 billion in a few months.
Yeah, once we changed our provisioning methodologies and models and decided to actually significantly increase those provisions. I mean, we put through another effectively 3 billion rands worth of provisions. Again, it's all in the interests of making sure that the business on a go-forward basis is in a fundamentally sounder, stronger, and more competitive place than it was before.
Let's go from the banking side, or the big picture side, to the Ellerines one. You talked I think in 2012, towards the end of 2012, saying we're actually reviewing whether we want this at all. And I thought back, and I remember interviewing at the time when you took it over in 2007-8, and you talked then about this business has got problems, but we expect it to work. So looking back, I know hindsight is perfect science. Would you have still bought Ellerines, or what happened?
Yeah, I definitely would have done the transaction. I think we would have done it somewhat differently to the way we did it, the way we structured the transaction on acquisition. We've learnt a lot along the way.
What you shouldn't have done?
Yeah, I think that we remember when we bought the business, we realized that there was a lot of risk inherent in the business that had been written post the NCA, the introduction of the NCA, which we then corrected and fixed. And then subsequent to that, we allowed too much risk to be played out through that retail footprint. We structured the relationship in a way that made that we separated the financial services too much from the retailer, and therefore the retailer became agnostic as to the quality of the credit that was
had no responsibility for the debt.
Yeah, and so in hindsight that was just wrong, and we should have done it better. But that's the past, and we are where we are now.
Still stuck with it though?
Yeah, look, I think Ellerines is a very valuable asset, and a lot of people look at it as a disaster or as a mess, and it's not. It's got a well-liked brands, it's got a huge distribution network of over 1,000 stores. There's a lot of value to be unlocked in Ellerines, and we have actually unlocked a lot of value. Just this last year was obviously not a great year, but historically we've done generated returns out of that business. We're now in a phase where Ellerines is going to be repositioned strategically, and we believe that it puts us in a place where we can engage with a broader retail group who would see that value in Ellerines, and that we would be able to offer what we offer through our own network and the Ellerines network into that expanded retail group as well.
At the toughest times, did you ever think of, look, I've had enough of this?
No, quite the opposite. I've really remained committed to it. I'm sure there's some people who wish that I did change my mind and do something different, but I'm really committed to the vision of this country and to what we can do as a business to change to better the citizens of this fabulous country of ours.
So is the worst over now?
Yeah.
You've rooted out everything you possibly can, financially, in accounting terms, in trade terms, in lending terms?
In every way.
This time next year, where will you be?
We'll be we are in a much stronger place. We'll have hopefully ensured that we've delivered according to our promises and not disappoint people again. But now we're in a much better place, and looking forward to we've drawn a line through 2013, and we're looking forward to the next and exciting chapter of the new African.